Every empire swears its money is safe. Every government insists its promises are permanent. Every central bank speaks with the calm certainty of a machine that will run forever. And every time, history proves them wrong. People have awakened across centuries. Roman citizens, French workers, Confederate families, Lebanese professionals, to the same nightmare. The numbers in the account are still there, but they no longer mean anything. Salaries become feeder, savings become ash. Futures get stolen, not by one villain, but by the slow collapse of trust itself. That is the core truth we refuse to face. Financial collapse isn't an exception in history. It is a feature. Systems fail, currencies break, institutions panic, and the only question that matters is not whether it can happen, but what survives when it does. Because the illusion of permanence is the most dangerous financial belief you can ever hold. We look at our bank balances and assume solidity. We look at national currencies and treat them like bedrock. But money is not bedrock. Money is belief. Money is shared trust turned into numbers, paper, and metal. And belief can evaporate in a weekend. That's why history is brutal, but also useful. Every collapse leaves fingerprints, patterns, warnings, and hard lessons about what actually protects wealth and what turns to dust. And if you pay attention, you notice something chilling. The survivors weren't the ones who trusted most in the system. They were the ones who doubted first, quietly, early, and without apology. Welcome to the Financial Historian, where money, power, and history collide, and nothing is ever as simple as it looks. To understand what survives when money fails, we have to confront a truth modern life encourages us to ignore. Money is a political invention. It is not a law of nature. It can be engineered, expanded, altered, frozen, and when the pressure rises, broken. And because money is a promise, governments are always tempted to stretch it. Sometimes they do it openly. Sometimes they do it in ways that sound technical, harmless, and temporary. But the result is often the same. The promise weakens, the trust cracks, and people rush for exits that are suddenly locked. The story repeats across time with different costumes. Coins become paper, paper becomes digits, but the human behavior underneath never changes. Start with the Byzantine Empire, the long-living shadow of Rome that survived for nearly 1,000 years after the West collapsed. Byzantium is often remembered for its walls, its emperors, its church politics, its glittering capital at Constantinople. But its true superpower was not simply military defense, it was monetary credibility. For centuries, the Byzantine gold solidus was the closest thing the medieval world had to a global reserve currency. Merchants across Europe, the Middle East, and North Africa accepted it because it was reliable, predictably pure, consistently valued, and backed by an empire that seemed unshakable. In a world of shifting rulers and fragile markets, that coin was trust you could hold in your hand. And you would think, after watching Rome destroy its own silver denarius through relentless debasement, reducing precious metal content until the coin became a propaganda token, the Byzantines would have learned the lesson. But history doesn't just repeat, it seduces. Centuries later, Byzantium made a similar mistake, only this time with gold. Purity was shaved, alloys were mixed in, the coin was stretched thinner to cover political needs. At first, almost nobody noticed. That's always how it starts. The system works because trust doesn't break immediately. It fractures slowly, invisibly, until suddenly everyone feels it at once. And when merchants began to doubt the solidus, the empire's commercial stability weakened with it. What survived this monetary rot? Not decrees, not official reassurances, not slogans about stability. What survived was real value held outside the government's reach. Merchants who had quietly accumulated gold that wasn't being diluted, land that could produce food, property beyond immediate imperial extraction. The first lesson appears with brutal clarity. Governments struggle to resist the temptation to dilute money, whether by debasing coins, printing notes, or expanding digital currency. And when they do, real value flees into assets that cannot be counterfeited with an edict. But not every failure comes from rulers tampering with currency. Sometimes collapse arrives through shocks so violent that even sound money cannot protect you. The Black Death, which tore through Europe between 1347 and 1351, remains one of the greatest demographic catastrophes in recorded history. In many regions, between a third and half the population died. Cities emptied, villages vanished, trade routes snapped, entire economies stopped, not because money disappeared, but because people did. Yet the economic story of the plague is more complicated than pure destruction, because when half the labor force disappears, labor becomes scarce, and what is scarce becomes valuable. Wages rose, workers gained bargaining power, land and food, previously expensive because people competed for them, became relatively abundant compared to human hands. Suddenly, survivors had leverage their parents could never imagine. Estates were unmanned, homes stood abandoned, fields were left unplowed. Assets that once required a fortune could be acquired cheaply by those with liquidity, goods, or skills. The survivors lived through tragedy, but some also experienced a rare economic inversion, a buyer's market created by mass death. It's horrifying. It's also true. And if that sounds uncomfortably familiar, it should. During COVID, we saw a modern version of the same dynamic. Supply chains disrupted, governments printing extraordinary sums to prevent economic seizure, markets whiplashing, and inequality widening as those with liquidity bought assets while those living paycheck to paycheck fell behind. In many countries, asset prices surged faster than wages. The wealthy acquired more, the vulnerable accumulated debt. Crisis redistributed wealth again, as it often does. The lesson is grim but consistent. Crises don't just destroy wealth, they rearrange it. Crises punish those without reserves and reward those who have them. Then there's the collapse of Renaissance banking, which teaches a different kind of warning. Institutions that look eternal can fall faster than you think. In the 1440s, Florence was Europe's financial capital. It wasn't just a beautiful city, it was a node in the bloodstream of commerce, dominated by powerful banking families like the Bardi and the Peruzzi. They lent to merchants, they financed trade, they extended credit across borders. They also lent to kings, massive loans, political loans, the kind of loans that look safe right until a monarch decides not to pay. And that is exactly what happened. Edward III of England defaulted on huge debts during his wars, and the shock rippled back into Florence. These untouchable banking houses collapsed, depositors were ruined, trade froze, confidence vanished. The ordinary citizen learned the hard way that reputation is not protection, and size is not safety. Too big to fail is not a modern lie, it is an ancient one. Institutions exist to profit. They do not exist to guarantee your survival. When they fail, they often fail in ways that sacrifice the public to preserve the powerful. Florence's lesson echoes across centuries, from banking panics and credit crashes to the modern reality that a bank account is not a vault. It is a claim, and claims are honored until they aren't. Now bring that reality into war, because war is the oldest accelerator of monetary collapse. The American Civil War is remembered for battles and abolition, but beneath the speeches and gunfire was an economic experiment most people barely understand. War on that scale required money beyond what either side could raise through ordinary taxation, so both sides printed. The Union issued greenbacks, paper currency not backed directly by gold, but by the promise of the United States government. It was an innovation and a necessity. But as more greenbacks entered circulation, they lost purchasing power. Inflation rose, the promise weakened. In the South, the problem became catastrophic. The South printed staggering quantities of graybacks while suffering blockade, supply constraints, and collapsing production. By the end of the war, Confederate inflation reached levels that feel surreal. Prices rose thousands of percent. Salaries became useless before they could be spent. And then in 1865, the Confederacy fell, meaning the currency didn't just inflate, it died. Confederate money became historical trash overnight. What survived were not patriotic paper, not government assurances, not the belief that it will bounce back. What survived was anything tangible:
land, food, livestock, tools, gold, assets rooted in physical reality. For ordinary Southerners, the collapse was devastating. Lifelong savings vanished. For those positioned with real goods and opportunism, the collapse created fire sale wealth transfers. This is a harsh truth of financial failure. Collapse is not equal opportunity suffering. It is often a redistribution, away from the trusting, toward the prepared.
Revolutionary France offers an even more explosive example: the speed at which political transformation can annihilate money. In the 1790s, French revolutionaries seized church lands and issued a paper currency called assignats, supposedly backed by the value of confiscated property. In theory, it was clever. Convert assets into liquidity, stabilize the economy, finance a new regime. In practice, governments rarely stop at enough. Printing became addictive. Every new issue diluted the last. Prices surged, wages lagged. The assignat became less a currency and more a rapidly rotting promise. Farmers refused to sell food for paper, demanding silver or goods. The market began to reject the state's chosen medium of exchange. Bread riots returned, social order cracked. The revolution devoured itself, and the ordinary citizen learned a lesson that repeats everywhere. A promise, no matter how noble, is only worth what others will accept. When acceptance breaks, your savings don't merely shrink, they can vanish. Fast forward into the modern era and the same pattern reappears with different mechanics: foreign debt and currency mismatch. The Asian financial crisis of 1997 began with Thailand and spread like fire through Southeast Asia. For years, Thailand had attracted capital and borrowed heavily, often in dollars, under the assumption its currency peg would hold. But when pressure mounted, the peg broke. The baht fell. And suddenly, debts denominated in foreign currency became crushing. Overnight, what looked manageable became impossible. Investors fled. Currencies across the region collapsed. Companies failed. Unemployment surged. Governments turned to the IMF. The people who suffered most were not the investors who sparked the panic and could exit quickly. It was ordinary citizens whose savings lost value, whose wages no longer covered basic needs, whose jobs evaporated as businesses imploded. Here, the lesson is sharp and mechanical. Debt in someone else's currency is a trap. When the local currency falls, the debt grows heavier without changing a single digit. And when the storm hits, the creditor rarely drowns, the debtor does. This dynamic has repeated in countless crises, from Latin American defaults to modern emerging market shocks, because it reveals how collapses can become global transfers of wealth. Assets get sold cheap, capital flows out, and outsiders buy what locals can no longer hold. And if you think this is old history or things that happen elsewhere, Lebanon should cure you of that comfort. Between 2019 and 2021, Lebanese banks did something that still sounds unthinkable to many people in stable countries. They effectively locked the doors. Depositors discovered their savings were trapped, withdrawals were restricted, accounts became illusions. Meanwhile, the Lebanese pound collapsed, losing the vast majority of its value. Middle-class families, retirees, engineers, doctors, people who did everything right by the rules of modern life, watched decades of work evaporate. They lined up outside banks begging for access to their own money, only to be told, in effect, that it wasn't really theirs anymore. This is the moment where people learn the truth that banking brochures never emphasize. Your deposit is not a treasure chest, it is a loan you have given the bank. And in a crisis, that loan can be repaid late, repaid partially, repaid in devalued currency, or not repaid at all. The people who survived best were those who had diversified outside the system earlier, held real assets, held foreign currency, or kept some value beyond the banking network. Everyone else was trapped inside a machine that stopped working. Now, zoom out. Look at the last 2 decades globally. In 2008, many people watched their homes seized and their retirements damaged, while institutions that helped cause the crisis received rescue. In 2020, massive stimulus and central bank interventions prevented depression, but also inflated asset values in ways that disproportionately benefited those who already owned assets. In 2023 and beyond, banking stress events reminded the world that confidence is always the real backstop, and confidence can move fast. The point is not to claim everything is about to collapse tomorrow. The point is to understand the structure. Money is trust, and modern systems are deeply dependent on belief. When belief fractures, the timeline compresses. Suddenly, things he thought required years can happen in days. So what survives when money fails? History offers no single magic object because collapses come in different flavors. Some are inflationary spirals where currency loses purchasing power until people reject it. Some are deflationary crashes where credit contracts and assets fall. Some are banking freezes where access, not value, is the crisis. Some are foreign debt traps where the local economy collapses under obligations priced in stronger currencies. But across these variations, the same survival patterns appear again and again. The first survivor is tangible value, assets that do not rely entirely on a government's promise. In Byzantium, merchants who held real gold or land preserved wealth when the currency's credibility cracked. In the Civil War South, those with food, tools, and property survived better than those holding paper. In revolutionary France, food and hard goods became superior to ideological currency. Tangible value doesn't guarantee safety. Property can be seized, gold can be stolen, goods can be destroyed, but it has one key advantage. It does not vanish simply because trust in a symbol collapses. The second survivor is liquidity, the ability to act when others cannot. After the Black Death, survivors with liquidity could buy land and homes cheaply. After financial crashes, those with accessible capital can acquire assets at depressed prices. Liquidity is not only cash, it is also access. A bank account might look liquid until the day withdrawals are restricted. Liquidity means you can exchange value quickly, safely, and reliably when the system is unstable. The third survivor is diversification across systems. People often misunderstand diversification as buy different stocks. History suggests a deeper meaning. Don't anchor all your life stability to one institution, one currency, one political system, one fragile promise. In crises like Lebanon, the people who had value in more than one place, foreign holdings, alternate currencies, property, skills, had options. Those with everything in one domestic banking network had none. And the fourth survivor is avoidance of fatal debt structures, especially debt that can explode when conditions change. The Asian crisis demonstrates how foreign currency debt can be lethal. But even within one country, variable rate obligations, short-term refinancing needs, or high leverage can turn a mild shock into a personal collapse. In crises, the problem isn't merely losing value, it's losing flexibility. Debt removes flexibility. Debt converts uncertainty into a countdown. The fifth survivor is the one most people ignore because it doesn't feel like finance. Productive capability, skills, networks, and the ability to create value when money loses meaning. In every collapse, people still need food, repairs, transport, medicine, security, and trade. When money fails, direct usefulness rises. The baker who can still feed a neighborhood, the mechanic who can keep machines running, the farmer who can produce, the trader who can move goods, the professional who can adapt. These people don't just survive, often they climb. This is one of history's most uncomfortable lessons. When money fails, production doesn't vanish. The world still needs real work, and those who can perform it become rich in whatever the new system values. This leads to a paradox that should wake you up. Collapse is both tragedy and opportunity. For the unprepared, it is ruin. For those with resilience, liquidity, and real value, it becomes the moment when assets can be acquired cheaply and social mobility can accelerate. After mass shocks, wealth doesn't disappear evenly. It moves, it transfers, often from the trusting to the prepared, from those trapped in promises to those holding something real. But there is a moral edge here, and it matters. It's tempting to turn these stories into a cynical survival guide. Be the shark, not the fish. But history doesn't just reward aggression, it rewards clarity. The aim is not to profit from suffering, the aim is to avoid being destroyed by illusions. Because the people who get wiped out aren't rarely irresponsible fools. Often they're ordinary, decent people who believed the system's promises because the system demanded that belief to function. They did what they were told. Deposit your money, trust the bank, trust the currency, trust the institution, trust the government. And that trust was weaponized against them when the system cracked. So the real question becomes, what do these collapses teach you about protection without paranoia? The answer is not to abandon society or live in permanent fear.
The answer is to respect fragility. Money can fail, banks can freeze, governments can lie, markets can break. And because that is true, you build your life like an engineer building in an earthquake zone. You don't assume the earth will be calm forever. You build with shock in mind. History's patterns are clear. When money is diluted, real assets become refuge. When shocks hit, reserves and liquidity create leverage. When institutions fail, reputation collapses faster than people expect. When war or revolution erupts, paper promises die first. When foreign debt is dominant, currency collapse becomes a debt explosion. When banks freeze, access matters more than account statements. When trust breaks, skills and production outlive symbols. And the most important pattern of all is psychological. Collapse punishes certainty. The people who get destroyed are often those who assume stability is guaranteed. The people who survive are often those who treat stability as temporary, valuable, but never permanent. Because money is not just economics, it is social coordination. It is an agreement, and agreements can break. When they do, what survives is whatever does not require universal belief to remain valuable. Land that produces, metal that is scarce, goods people need, skills people pay for, networks people rely on, and the flexibility to move.